What is a P/E ratio and why every investor needs to know it? Okay, so you're about to find out why Warren Buffett could look at a stock for literally 10 seconds and know whether it's worth buying, while most people are completely clueless. And it all comes down to one number that Wall Street obsesses over. Stick around because this changes everything about how you invest. Welcome back. Before we dive in, if you're serious about building wealth, hit that subscribe button because we break down money moves that actually work. Let me set this up with a real scenario. Imagine I'm selling you a pizza business. The business makes $10,000 a year in profit. One person offers me $50,000 for it. Another person offers me $200,000 for it. Same business. Radically different prices. Why? Because one person sees it as a bargain and the other sees it as overpriced. That's exactly what a P/E ratio is doing with stocks. Part 1. What a P/E ratio actually is. P/E stands for price to earnings. Here's the simplest way to understand it. You take the stock price and divide it by the company's annual earnings per share. That's it. That's the whole thing. Let's use a real company. Say Apple stock is trading at $400. Apple made $50 per share in earnings last year. The math is 400 divided by 50 equals 8. Apple's P/E ratio is 8. That means you're paying $8 for every $1 of annual profit the company generates. Now let's compare that to Tesla. Tesla stock might be trading at $250 but only earning $5 per share. 250 divided by 5 equals 50. Tesla's P/E is 50. You're paying $50 for every $1 of profit. Same market, two completely different valuations. This is where most people get lost. But I'm going to make it crystal clear. Part 2. Why this actually matters to your money. Here's what's happening underneath. A low P/E ratio typically means a stock is cheaper relative to its earnings. That sounds good, right? It can be. You might be getting a bargain. But sometimes a low P/E means the company is boring, mature, or the market doesn't expect growth. A high P/E ratio means investors are paying premium prices. Why? Because they believe the company will grow earnings significantly in the future. Tesla's 50 P/E isn't crazy because Tesla believers think earnings will explode. That's the bet. Here's the critical part. The average P/E for the S&P 500 is around 20. If you're buying index funds through your Roth IRA or 401k at Fidelity or wherever, you're buying a mix of companies with different P/E ratios that average out to around 20. That's your baseline. When you see a stock with a P/E of 12, it looks cheap compared to 20. When you see one at 40, it looks expensive. But here's the trap. Cheap doesn't always mean good. Netflix might have a P/E of 30 because Netflix is expected to grow. Utilities might have a P/E of 12 because they're stable but not growing much. They're different animals serving different purposes in your portfolio. Part 3. How to actually use this. If you're on Robinhood or any brokerage, you can look up any stock's P/E ratio in literally 3 seconds. It's right there in the stock information section. You should be checking this before you buy anything. Here's how smart investors use it. First, know the P/E ratio of what you're comparing it to. If you're looking at a tech stock, compare its P/E to other tech companies, not utilities. If you're buying individual stocks at all, never buy something without knowing its P/E ratio. Second, use it as a conversation starter with yourself. If you're looking at a stock with a P/E of 60, ask why. Is the company growing that fast? Is the market overhyped on it? Are you getting in before a massive run or getting in at the peak? Third, use it alongside other metrics. P/E ratio isn't the whole story. Look at growth rate, profit margins, debt levels. But P/E is the single best starting point. Here's the honest truth. Understanding P/E ratio separates people who make money investing from people who lose it. Most people pick stocks based on tips from their cousin or something they heard on TikTok. You're going to actually know what you're buying. For your Roth IRA, your 401k at work, your taxable brokerage account, whether you're using Fidelity, Vanguard, or Robinhood, knowing this one metric makes you dangerous in the best way possible. Start checking P/E ratios today. Start asking why. And never again will you be the person throwing money at a stock because everyone's buying it. If this made sense and you're ready to level up your investing knowledge, hit subscribe. We drop videos on this stuff every single week. Comment below with a stock you want us to break down. Let's get you making smarter money moves starting right now.